Why do investors repeatedly make the same mistake, even when they know it's a mistake? Many investors say, I know I shouldn't panic sell. I know I shouldn't chase hype. I know I shouldn't overtrade. Yet they repeat the same behaviors. This is not ignorance. It's psychology. Here's what research tells us. 1. The intention-behavior gap. Knowing something intellectually does not guarantee behavioral change. Psychologists call this the intention-behavior gap. You can understand long-term investing, believe in discipline, value patience, and still act impulsively. Why? Because decision-making under emotional arousal activates different neural systems than calm reflection. 2. System 1 overrides System 2. According to Daniel Kahneman, human thinking operates through System 1 fast, emotional, automatic. System 2 slow, rational, analytical. When markets move sharply, fear activates System 1. Stress hormones rise. Urgency increases. System 2 becomes weaker under stress. So even if you know the right strategy, emotional processing overrides it in the moment. 3. Dopamine reinforcement loop. Neuroscientist Kent Berridge distinguishes between liking and wanting. Repeated trading may not produce happiness, but it creates anticipation. Anticipation triggers dopamine. The cycle becomes trigger action emotional spike repeat. Even negative outcomes can reinforce behavior if the anticipation phase is stimulating. This explains why investors repeat behaviors that previously hurt them. 4. Variable reward schedules. Behavior under uncertainty follows the same reinforcement structure found in gambling. Random rewards are powerful. Occasionally, panic selling works. Chasing momentum pays off. Overtrading captures a lucky gain. These intermittent wins create powerful reinforcement. The brain remembers the rare success more vividly than repeated small losses. 5. Regret aversion and narrative repair. Behavioral economist Richard Thaler describes how regret shapes decisions. When investors regret an action, I should have sold, they become more likely to overreact next time. Past regret alters future behavior. Ironically, trying to avoid regret often creates more regret. 6. Identity protection. Admitting a repeated mistake threatens self-image. To protect identity, investors may justify the action, reframe losses, double down to prove they were right. This is linked to cognitive dissonance, discomfort from holding conflicting beliefs. Instead of changing behavior, the mind changes the story. 7. Emotional memory is stronger than rational memory. The brain encodes emotional experiences more strongly than analytical insights. You may intellectually remember, stay disciplined, but emotionally remember, the last crash hurt. Under pressure, emotional memory dominates. Why awareness alone is not enough. Repeated mistakes happen because emotional systems override rational plans. Intermittent rewards reinforce bad habits. Regret reshapes future reactions. Identity resists admitting patterns. Stress weakens long-term thinking. Knowledge operates in calm states. Mistakes occur in activated states. Practical solutions. Pre-commit to rules in writing. Automate investing decisions. Introduce a mandatory delay before trading. Reduce exposure to frequent price checking. Conduct postmortems after emotional decisions. Behavior changes through structure, not insight alone. Core insight. The investor who repeats mistakes is not irrational. They are human. The market doesn't just test strategy. It tests emotional regulation. Mastering investing often means mastering the part of you that already knows better, but still reacts.